Okay, we'll continue with leasing. Last class I had started with leasing, wherein we had done two problems. We were evaluating it from lessor's point of view. In lessor's point of view, the objective is to calculate the lease rent to be charged. What rental should the company charge so that the lessor gets his desired rate of return. In this, today we will continue with lessor for some time and then we proceed to lessee. Let's come to question 3. ABC Limited is in the process of making out a proposal to lease certain equipment to a user manufacturer. The cost of the equipment is 10 lakhs. Primary period of lease is 10 years. ABC Limited is able to give you the following additional information. Machine can be depreciated fully over the 10 years. Effective rate is 40%. It will go down to 30%. Objective is to earn a 10% post-tax return. Lease management fee is 1%. Lease rents are collected at the beginning of every year. You are required to determine the equated annual rent to be charged for the proposal. Equated annual rent to be charged for the proposal. We are going to do it in 3 steps. Step 1 initial outflow, step 2 in between flow, step 3 terminal flow, step 4 consolidate and calculate NPV. Working note 1 initial outflow. Working note 1 initial outflow. Initial outflow, particulars and amount, particulars and amount. Point number 1, capital expenditure. Capital expenditure. How much the capital expenditure? ₹10 lakh is the capital expenditure. Working capital 0. Wait. There is one more item which happens on day 0. Can you read and find that? What is inflow? Yeah, lease payments are coming at the beginning of the year. Now listen, what we will do is we will consider the lease payment at the beginning of the year, but the tax expense for the same would be considered at the end of the year. Alternatively, a lot of authors say if it's beginning of the year, tax also beginning because of advanced tax provisions. So different views are there. Institute normally subscribes to the view of end of year. So point number 3 is lease rent of year 1. Lease rent of year 1 X rupees. I don't know what is that. Lease rent of year 1 is X rupees. We'll calculate this in some time. I don't know the amount. So initial outflow is X minus 10 lakh. X minus 10 lakh. That's my initial outflow. Working note 2 in between flow. Working note 2 in between flows. Working note 2 in between flows. Now listen, it's a little tricky. Particulars year 1 to 5 I combine it together. After the 5th year the tax rate undergo a change. Year 6 to 9 I combine it together. The tax rate is changing, and year 10 is separately because in year 10 there is no inflow. You will not get any lease rental. Year 1 to 5 you will be getting the, listen, what you write in 1 to 5 is the lease rental of 2 to 6. You write 1 year in advance. So the lease rental comes a year in advance. The amount is going to be same. So they have told you are going to charge the same amount. So that issue is not there. So I am going to write X as the lease rental for 1 to 5 and 6 to 9. Tax for the same will be 40% for the first 5 years and the next 5 years is 30%. Point number 1, lease rent, lease income, X and 0. 10th year you don't get anything. Lease income X and 0. Lease income X and 0. Lease income X and 0. First to 5th year you get X rupees, 6th to 9th year again you get X rupees, 10th year you don't get anything. The basic thing is this X is written a prior and advance. Any doubts on this? Any expenses? Lease management fee of 1% of the value of the asset is usually collected from the lessee upon signing to cover the overhead cost. Now what does this mean? Income expense. Okay, it's neither income nor expense because I collect it and spend it. So it's neither my income nor my expense. I don't have any other income. I get lease rental. This is, he is saying 1% is for expenses meeting. If this 1% includes some profit element, that is I collect 1% but I spend only 0.5%, then balance half is going to be my income. So there is, this amount is basically of no use to the question. So lease income, point number 2, less depreciation. 1 lakh. PBT. In fact, PBT remains same from 1 to 9, but the tax rate will undergo a change. It's more because of the tax rate, we are mentioning it like this. Minus 1 lakh. PBT is X minus 1 lakh, X minus 1 lakh and minus 1 lakh. I wouldn't have distinguished between 1 to 5 and 6 to 9 if the tax rate was same. With distinction will come only for year 10. Point number 4, less tax. What's the tax rate? Now listen, whatever you collected in the first year 0, the tax for that is getting paid now. It didn't really matter because the amount of rental is same. If the rental was to change, first installment X, next installment 1.1x, then 1.21x, then when you do tax, you cannot do it like this. You will have to separately write every item because tax will be on the prior year income. Because you write the income at the beginning of the year and the tax for the same would come at the end of the year. It did not matter in this question because the lease rental is remaining same. So less tax is 0.4 into X minus 1 lakh. 0.4 into X minus 1 lakh. 0.3 into X minus 1 lakh. 0.3 into minus 1 lakh became positive 30,000. 0.4 into X minus 1 lakh. 0.3 into X minus 1 lakh and 30,000. Any doubts on this? PAT, I'll multiply and round it off. 0.6x minus 60,000 0.7x minus 70,000 and this year is minus 70,000. PAT is minus 70,000. We add back depreciation and we get CFAT. 1 lakh of depreciation is added back. Basically, we earn rental of 0.6x for the first 5 years, 0.7x for the next 4 years, and last year is, just a minute. something got missed out. Just give me a minute. I think X is the lease income. X is the lease income. Year 10 we don't have any income. Okay, so I'll explain this as one thing got missed out here. Listen, from a P&L point of view, the income will be X rupees. From a P&L, from a profit and loss account point of view, the income will be X rupees, and this is going to be X minus 1 lakh, X minus 1 lakh from a P&L point of view, because every other year from a P&L point of view it's the same thing. X minus 1 lakh is what the P&L is going to do. From a P&L point of view it's going to be X minus 1 lakh. So this amount will become 0.3 X minus 1 lakh. This will become 0.7 X minus 70,000. You add back 1 lakh, 0.7 X plus 30,000. Wait. Now the point is, when I do this 0.6 X plus 40,000, the lease rentals are received a year in advance. So all the 5 years you get lease rental. All the 5 years you get the lease rental. Here all the 4 years you get the lease rental. In the last part alone, I do something called as a adjustment of LR not received. Adjustment of lease rent not received. Why I do this adjustment is, year 1 to 5 I get a lease rental. Years to 6 to 9 also I get a lease rental. Year 10 also I get a lease rental, but I write that at the beginning of the year. So this is how my P&L will look. From P&L point of view, this will be the thing. Adjustment of lease rent not received is X, and revised CF80 is, let me just do this, I'll explain again. This, and this year alone is 30,000 minus 0.3x, 30,000 minus 0.3x. Now listen, what is this 30,000 minus 0.3x is? Basically the last year you will pay only income tax. Last year you will have to pay tax on the lease rental, but there is no income. Last 10th year there will be tax on lease rental, but there is no income per se as far as lease rental is concerned. There is no income as far as lease rent is concerned when it comes to the last year. Any doubts in this? So effectively, just to check our answer, listen, 0.6x is what I receive for 5 years, 0.6x I receive for 5 years, 0.7x I receive for 4 years, 0.7x I receive for 4 years, and minus 0.3x for 1 year, minus 0.3x for 1 year. Apart from that, just give me a minute. Apart from that, in the beginning year you wrote an X. In the beginning year you wrote an X. So lease rental 1, 3, 2.8 and minus 0.3. Effectively it is adding up to 6.5. Effectively it's adding up to 6.5. That 6.5 is nothing but 60% of lease rental for 5 years and 70% of lease rental for 5 years. 60% of post-tax lease rental for the first 5 years and 70% of post-tax lease rental for 3 years, for the next 5 years. So in fact in this also, no, I should do adjustment of LR not received and adjustment of LR received in advance. For the for year 1 to 5 also, you don't receive a lease rental for that year and you receive a lease rental in advance for a year. So X and X will get cancelled. 10th year alone that possibility does not exist. 10th year alone that possibility does not exist. Write this. Revised CF80. 0.6x plus 40,000, 0.7x plus 30,000, 30,000 minus 0.3x. I should have done that. I realized it afterwards, saying that I could have presented in a little different manner. I didn't think about the year 10 complexity. How I could have presented this answer in a different way is, okay, let me complete it fully and then I'll tell you in the step 4. When I go to the step 4, I'll tell you how I could have presented this better. Working note 3, terminal flow. Working note 3, terminal flow. Working note 3, terminal flow. Particulars and amount. Net salvage value. Recapture of working capital. Recapture of working capital. Net salvage value and recapture of working capital. Is there any salvage value given in the question? 0. Recapture of working capital 0. Total terminal flow is 0. Total terminal flow is 0. Total terminal flow is 0. Next, computation of lease rent. Year cash flow. Year cash flow PVF at 10% and DCF. Year cash flow PVF at 10% and DCF. 0, 1 to 5 together, 6 to 9 together and year 10 separately. 0, 1 to 5 together, 6 to 9 together and year 10 separately. Zero is x minus 10 lakh, x minus 10 lakh, x minus 10 lakh. 1 to 5 is 0.6x plus 40,000, 0.6x plus 40,000, 0.7x plus 30,000, 0.7x plus 30,000, and last year is 30,000 minus 0.3x. This has to add up to 0. This has to add up to 0. complete this, I'll tell you we could have done this in an easier way, somewhere complicated a little bit. You will get it as 171,444. You can just do the calculation, let me know whether that's the number. 171,444. I'll tell you a better way of doing this now. 171,444. Any doubts on 171,444? Just let me know whether you are getting that, because I am also not sure on the answer. So just check the calculation and let me know whether you get that number. 171,444. Okay, now listen, I could have presented the entire stuff. I didn't wanted to continue the same format, so maybe where I have complicated a little. Listen, year, capex, lease rent, tax on lease rent, depreciation, NCF, PVF and DCF. I may not be in a position to use annuity. So capex is minus 10 lakhs, lease rent is X for the first 9 years, for the first year 0 to year 9. Tax on lease rent is minus 0.4x, minus 0.4x. For the first 5 years is minus 0.4x. Next 5 years is minus 0.3x. Next 5 years is minus 0.3x. Depreciation, I'll write only the tax benefit. The benefit is first 5 years is 40,000 rupees. First 5 years is 40,000. Next 5 years is 30,000. NCF is capex plus lease rent plus tax on lease rent plus depreciation benefit. So for the first year it is minus 10 lakh plus X. Second year is 0.6x plus 40,000. Sorry, year 0 is minus 10 lakh plus X. Then you have 0.6x plus 40 for 1, 2, 3, 4, 5. Sixth is 0.7x plus 30. Seventh same, eighth same, ninth same, and last year is 30,000 minus 0.3x. Could have been better. This could have been better to do. Any doubts in this? Any doubts in this part? Clear? Let's move to the next question. Question number 4. ABC Limited has been approached by a foreign embassy to build for them a block of 6 flats to be used as guest houses. As per the terms of contract, the embassy would provide ABC Limited the plans and the land costing of 25 lakhs. ABC Limited would build the flats at their own cost and lease them out to foreign embassy for rental chargeable on annual basis, and at the end of 15 years the building shall be transferred. ABC Limited estimate the following. ABC Limited present tax averages at 50%. Full cost of construction registration will be written off and allowed for tax purposes. You are required to calculate the normal lease rent per flat with the following assumptions. Minimum desired rental of 10%. Rentals and repairs will arise on the last day of each year. Construction and registration and other costs will be incurred today. Let's go through the question. Okay, we'll end up putting the information in the same 3 stages. Working note 1 will be initial outflow, working note 2 in between flows, working note 3 terminal flow. Working note 1 initial outflow, working note 1 initial outflow. So if it's going to take multiple years, you will have to find in which year the construction is going to happen and write in that year.
We won't be, for example, first year it is like 500 lakhs, second year it is 400 lakhs, and third year it is 300 lakhs.
Sir,
will we do generally for all?
No, so you will write, when I say initial outflow, what number comes as here? Only year 0 number. So if there is nothing happening in year 0 and if something is happening in year 1, if you remember the format of capital budgeting, after CFAT we have something called as add purchase of additional machinery, payment for original machine. So there it will come, because it's like purchase of additional machine. You buy it at the end of first year, second year, third year.
But unless and until it reaches the full thing, I won't be getting increase.
Correct. So you will do year 0 no cash flows, year 1 500 lakhs outflow, year 2 400 lakhs outflow, year 3 300 lakhs outflow, year 4 lease rental start. You have to estimate the year. So estimation of year. So what I say is initial outflow is year 0. If the question says nothing happens on day 0, initial outflow is 0, that's all. Particulars and amount. Capital expenditure. Read the question and let me know this number. Some construction cost into what? Okay, 400 per square feet into 1000 square feet into 6 flats. 400 per square feet into 1000 square feet into 6 flats. This is basically the construction cost. In fact, you can change the word capital expenditure to construction cost, because there are multiple items. I'll change it as construction cost itself. There are multiple items. Construction cost is 24 lakhs. What about land? Land is what they mentioned. It is costing of 25 lakhs. And as per the terms, embassy would provide ABC Limited the plans and the land costing of 25 lakhs. So land is neither my income nor my expense, so it is 0. Any other expense happens on day 0, there is one more expense. Registration charges. Registration charges. What have they mentioned about registration? 2.5%, which is 60,000 and my initial outflow is 24 lakhs 60,000. My initial outflow is 24 lakhs 60,000. Construction is 24 lakhs, land is 0, registration is negative 60. Overall I spent 24 lakhs 60,000 over a span of on day 0, sorry, 2460 on day 0. Okay, lease rent, there is a structure 1 to 5 normal LR, 6 to 10 120% LR, 11 to 15 150% LR. Now listen, I'll assume the lease rent to be X. Can you tell me what are the years column I should do? Particulars, which and all can be clubbed? 1 to 5, then 6 to 10, 11 to 13, 14 to 15 can be clubbed, or 14 and 15 can be written separately also. Why 14 and 15 is separate is there is a repair charges. There is a repairs of 4 lakhs. So we will have particulars 1 to 5, 6 to 10, 11 to 13 and 14 to 15. 1 to 5, 6 to 10, 11 to 13 and 14 to 15. You before that you can write, let us assume the lease rent to be X, normal lease rent to be X. In fact, last problem also we should have made this assumption. In between flows, particulars 1 to 5, 6 to 10, 11 to 13, 14 to 15, 1 to 5, 6 to 10, 11 to 13 and 14 to 15. 1 to 5, 6 to 10, 11 to 13 and 14 to 15. Lease rent 1 to 5, 6 to 10, 11 to 13 and 14 to 15. The lease rent for the first 5 years is X, 6 to 10 is 1.2x, 11 to 13 is 1.5x, 14 to 15 is also 1.5x, x 1.2x, 1.5x and 1.5x. Any expense given in the question? After lease rent I have to deduct expense, deduct depreciation. So before depreciation is there any expense? Repairs, yeah, repairs is the only expense which is there, minus repairs, nil, repairs. 14 and 15 is how much? 4 lakhs. See this, sometimes student make a mistake of writing 8 lakhs. You cannot write 8 lakhs because this calculation is for year 14 as well as year 15. The amount is written in 14th year as well as 15th year, just that we have clubbed that column. That does not mean I'll have to double the amount. Next, minus depreciation. Minus depreciation. Now there is a salvage value given in the question, but the question has said that full amount will be written off over 15 years. Somewhere it said full cost of construction and registration will be written off in 15 years and will be allowed for tax purpose. There is some salvage value. Somewhere it said that they will hand it over at 8 lakhs. So if that line was missing, then I would have subtracted 8 lakhs and computed depreciation. Because of that line, it is 24 lakhs 60,000 divided by 15 years. 2460 divided by 15 years. 164. x minus 164, 1.2x minus 164, 1.5x minus 164, 1.5x minus 564. Less tax PAT. %50 tax. Don't simplify at this stage. The tax and the PAT is same. PAT, add back depreciation and get CFAT. Point 5x plus 82, 0.6x plus 82, 0.75x plus 82, 0.75x minus 118, 0.75x minus 118. Any doubts on this? Clear? Can you proceed? Working note 3, terminal flow. Terminal flow. Particulars and amount. Sale value. Sale value. At what value the building would be sold now? 8 lakhs. Less book value. What's the book value? 0. sale value less book value, capital gain 8 lakhs, capital gain 8 lakhs, tax on CG 4 lakhs, and my NSV sale value minus tax. NSV is this 8 lakh minus 4 lakh, turns out to be 4 lakh, turns out to be 4 lakhs. Clear? Any doubts on this? Now I'll consolidate this and solve x, that x is the normal rent, that x is the normal rent, 1.2x will be higher and 1.5x will be higher. So we will consolidate, equate it to 0, year cash flow PVF at 10% and DCF, year cash flow PVF at 10% and DCF. When you do 6 to 10 annuity factor, what you need to do is 1 divided by 1.1 equal to you do 5 times, don't put a m plus there. 6th time onwards equal to m plus, 7th equal to m plus, 8th equal to m plus, 9th equal to m plus, 10th equal to m plus and an MRC. One divided by 1.1 equal to m plus 5 times, 3.791. Start again from the beginning. 1 divided by 1.1 equal to, don't do anything, equal to, you get the 5th year value. 6th equal to m plus, 7th equal to m plus, 8th equal to m plus, 9th equal to m plus, 10th equal to m plus and an MRC. you do this and check the answer. I'm not very sure if at all there's a calculation mistake. So the normal rent is 4,18,073. 418,073 is the normal rent to be charged. You are required to calculate the normal lease rental per flat. You divide by 6. This is calculation was done for 6 flats. That 418,073 is the cumulative rent for all the 6 flats put together. It's the overall rent for 6 flats. Cost was for 6 flats. Repairs was for 6 flats. So finally, normal rent per flat. Normal rent per flat 418,073 divided by 6, 69,679. 69,679. That's going to be the normal rent per flat. 69,679. 69,679. Any doubts on this? Negative 2460, 0.5x plus 82, 0.6x plus 82, 0.75x plus 82. 14 and 15 have to be segregated now because 15 has a salvage value. 0.75x minus 118, 0.75x plus 282. Overall, the total is 4.4038x minus 18,41,108. Some up down rounding off can happen. Now, finally, normal rent is 4,18,000 and per flat is 69,679. Any doubts on this? Clear? Are you getting this? Can I proceed to the next question? Okay. Go through the next question. Go through question 5. Go through question 5. Okay. Now, technically this question 5 is not from a lessor's perspective, it is more from a lessee perspective. It's more from a lessee perspective. We are going to bring lessee also into picture. A company wants a machine, they have two options. One, go for purchase of machine, and second, go for leasing of machine. If you go for purchase of machine, you are the owner of the machine. Now, mostly it's higher analysis is from lessee point of view. Let's understand this now. Asset by lease. If it's lease, only two things happen: lease rent and tax on lease rent. That's all, nothing else is there. There's a lease rental expense and there's a tax on lease rental. So you save taxes because there is a lease rental expense. So net your tax, net your expense is lower because of the tax angle. When you buy the asset, initial outflow, okay, sorry, I'll not do that way because you are going to use the asset for your own purpose. You're going to use it for own purpose. So when you buy the asset, there will be interest, there will be principal, because you have to pay interest and principal. You are going to take a loan and buy this. Tax saving on interest, tax saving on depreciation, because you are the owner, you can claim depreciation. Just a minute. Salvage value. Yeah, tell me, what's it? Yeah, saving only, tax saving only. So lease rental is your expense and tax is saved on the lease rental. This side you will pay interest, you will pay principal. These are your outflows. On interest you will save tax, on depreciation you will save tax, and there is a salvage value. Now onwards, all outflows will be written as positive and all inflows will be written as negative. We will write all outflows as positive and all inflows as negative. Now the question says that I want an asset worth 5 lakh rupees. I can go for lease. And the other option is I can go for borrowing. If I go for borrowing, the borrowing amount is 5 lakh and it's payable at the rate of 10% per annum. Principal amount will be paid in 5 equal installments to be paid annually. Listen, sometimes they will use the word principal will be paid in 5 equal. Principal is paid in 5 equal means 5 lakh divided by 5 is the payment every year. 5 lakh divided by 5 is the. Sometimes there will be loan will be paid in equal installments. Then it is called as equated annual installment, which is interest plus principal put together will be the same amount. You calculate using annuity factor. I'll explain as we proceed. Machine will be sold at 50,000. Further information, principal, interest, machine will be fully depreciated, tax rate, all that information is given. Working note 1, evaluation of loan option. Working note 1, evaluation of loan option. Evaluation of loan option. Evaluation of loan option. In that part 1, loan amortization table. Loan amortization table. Loan amortization table. Year opening balance, interest, principal and closing balance. Year opening balance, interest, principal and closing balance. What's the amount of loan we are taking? 5 lakhs. So opening balance is 5 lakhs. Opening balance is 5 lakhs. Interest rate is, so first year into 0.1 into 0.1, 50,000. Principal is 1 lakh every year. Principal is 1 lakh every year. And my closing is opening minus principal. The principal is to be paid in 5 equal installments. So 5 lakh divided by 5 is the payment. Year 1 closing balance is 4 lakhs. Year 2 opening balance is 4 lakh, interest is 40,000, 10% of that, principal continues to be 1 lakh, closing balance is 3 lakh. Then 3 lakh, 30,000, 1 lakh, 2 lakh. In the end, the loan will become 0. In the end, the loan is going to become 0. Principal is getting repaid as 1 lakh every year. So every year you are not going to pay only 1 lakh, you will have to pay 1 lakh plus 50,000. Second year you will have to pay 1 lakh plus 40,000. Third year you will have to pay 1 lakh plus 30,000. Fourth year you will have to pay 1 lakh plus 20,000, and last year you will have to pay 1 lakh plus 10,000. In which? In which amount? 1 lakh. Correct. 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 No, principal means it's the on 5 lakh. You are not, so if you say you are paying principal of 1 lakh, it means closing balance of, so how do you say is you are paying principal of 1 lakh and a total amount of 1 lakh 50,000. So if you want to use the word, then you can say opening balance, interest, repayment plus interest and closing balance. So you will see another table called as opening balance, interest, installment and closing balance. When I use the word installment, what I will do is closing balance is opening plus interest minus installment. Opening plus interest minus installment. If I am using the word principal, let me directly deduct the principal, because I need not add. So it's not that I am paying 1 lakh in the first year, I have to pay 1 lakh as well as 50,000, both have to be paid. Part 2, present value of loan option, present value of outflow 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 of loan option, of outflow of loan option, of outflow of loan option. Okay, listen, we can have multiple columns. Let's just freeze on the columns. Listen, there is going to be year, listen for some time, interest, principal, depreciation, tax saving on interest plus depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF and DCF. What is net cash flow is interest plus principal minus tax saving on interest and depreciation minus salvage value. All inflows will be deducted, all outflows will be added. Interest is my outflow, principal is my outflow, depreciation is neither inflow nor outflow, tax saving on depreciation is inflow, tax saving on interest is inflow, and salvage value is inflow. Salvage value is inflow. This is what will be there in most of the questions. Sometimes you may have certain extra items also. So year, interest, principal. Listen, some question instead of using the word interest and principal, I'll use year, interest, installment. If it's installment, principal and interest is already added. So your NCF is installment minus tax saving on interest and depreciation minus salvage value. Why I use the word installment? Because installment is earlier calculated. I don't want to calculate principal again. There's no point in doing that calculation. So write year, interest, principal, depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF, DCF. The only important rule is you will have to consider all outflows as positive and all inflows as negative. 5 years. Copy the interest and principal. Copy the interest and principal. Interest and principal. Copy the interest and principal. 50, 40, 30, 20 and 10. 1 lakh for all the 5 years. Can you tell me what's the depreciation per annum? Depreciation per annum. How much? Read the question carefully. Depreciation is how much? The question says machine will be fully depreciated over its effective life. If that line was missing, then it's 5 lakh minus 50,000 divided by 5 years. 5 lakh minus 50,000 divided by 5 years, because there is a salvage value of 50,000. Question has said it will be fully depreciated. If it says fully depreciated, I'll write this as 1 lakh for all the 5 years. Fully depreciated, that's the question's requirement. Machine would be fully depreciated over its effective life. Machine will be fully depreciated over its effective life. One lakh is the amount. My tax saving is, what's the tax rate they have mentioned? 30%. So 0.3 into interest plus depreciation. 0.3 into interest plus depreciation. 30% of interest and depreciation. 30% of interest and depreciation. I'll put it as negative. Interest and depreciation. You can even write it as positive, but take care of the calculation. When you do the computation, you'll have to subtract this. Interest and depreciation. Tax saving on interest and depreciation. What will be the salvage value number? How much? No, it's not 50.
0 minus 50,000 minus 0 minus tax.
So what is that?
30,000.
Yeah, you can do computation if you want. It will be 35,000. Listen, sale value will be 50,000, book value will be 0, capital gain will be 50,000, tax paid will be 15,000, and NSV is going to be 35,000. If you want, you do a separate working. NSV is 35,000 because we had fully depreciated the asset. We had earlier fully depreciated it, so it's going to be 35,000. NCF is interest plus principal minus tax saving minus salvage value. Interest plus principal minus tax saving minus salvage value. 105, 98, 91, 84 and 42. One 105, 98, 91, 84 and 42. The salvage value is 35,000. If you want to show a working, you can show the working. What is the cost of capital they mentioned? 8%. It's more from a lessee point of view rather than lessor point of view, this problem. I will have to spend 3,43,812. 343,812 is the amount to be spent. 343,812 is the amount to be spent on the loan option. Any doubts in this? Clear? If this is clear, we'll move to lease option. If there's a doubt, let me know. Any doubts on the loan option? Can we proceed? We have done discounting at 8%, we get to 343,812. I'll explain something on discount rate later on. As of now, this is fine, 343,812. Any doubts on this? Next, working note 2, evaluation of lease option. Evaluation of lease option. Lease is very simple. Year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Any doubts on 343,812? Okay, is the lease rental given in the question? What did I mention? Lease rent which will make the firm indifferent to the loan option. Now listen, year 1 to 5, I'll pay a lease rent of 0.7x. What is 0.7x is x rupees of lease payment, 30% of tax benefit. The only thing which I know is the total should be 343,812. If it's 343,812, I am indifferent. If it's 343,812, I am indifferent. If it's not 343,812, then indifference does not exist. So I will be indifferent between loan and lease if my present value of outflow of lease option is also 343,812. So my PVF will be this number, which is 3.993. And we get this as 2.7951x, and we will equate this 2.7951x to 343,812. We will equate this to 343,812, and that is my indifferent lease rental. Anything higher than that, loan will be preferred. Anything less than that, lease would be preferred. So year 1 to 5, you can write, let us assume the lease rent to be x. Let us assume the lease rent to be x. Let us assume the lease rent to be x. Point 7x is the lease rent, and overall it is 2.795. So this is also called as break-even lease rent, BELR, or indifferent lease rental. Break-even lease rental or indifferent lease rental. 343,812 divided by 2.7951. 1,23,000 is to be charged. 123,005. 123,005. If I am getting a lease rent of 123, I would prefer both of them. I am indifferent. If lease rent is less than 123, leasing is preferred. If rent is more than 123, loan is preferred. So the break-even lease rental or indifferent lease rental is 1,23,005. 1,23,005. Any doubts on this? 123,005. Any doubts on this? Can we proceed? Okay, this is a very good problem. It explains everything. Next, part 2. Part 2, interest rate which will make the firm indifferent. Interest rate which will make the firm indifferent. Interest rate which will make the firm indifferent to the loan option. if LR is 120. Part 2, interest rate which will make the firm indifferent to the loan option. If LR is 120, if LR is 1,20,000, if lease rental is 1,20,000, okay, in that part 1 evaluation of lease option, 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 evaluation of lease option, evaluation of lease option. Now listen, the break even lease rent was 123. Now he is saying he is going to charge 120. I can still go with the loan if the interest rates come down a little. The interest rates are currently at 10%, maybe that doesn't work. If interest rates come down, maybe I'm okay. So year 1 to 5, lease rent is 84,000. Lease rent is 84,000. And my present value of outflow of lease is 335,412. 335,412. This is lease option. Lease rent is 84,000. 84,000. 3.993. 335,412. Any doubts on this? 1,20,000 into 1 minus tax rate. No, we assumed X as lease rent. No, we wrote 0.7x in the calculation. We wrote 0.7x in the calculation. So 0.7x was what? So we had assumed X to be the lease rent. In this question they have said lease rent is 120, post tax is 84,000. Okay, now listen, you guys are going to do it. What you need to do is listen for some time. Just give me a minute. Okay, this is how your table looked earlier. Interest, principal, everything was looking like this. Now what I will do is, first year interest is 5 lakh x, x is the rate of interest. First year interest is 5 lakh x, x is the rate of interest. Second year is 4 lakh x. Third year is 3 lakh x. 2 lakh x. 1 lakh x, and the one thing which I know is the total year has to match 335,412. The total has to match 335,412. Any doubts in this? So interest is 5 lakh x, 4 lakh x, 3 lakh x, 2 lakh x and 1 lakh x. X is the rate of interest. You will get the rate of interest in some time. Any doubts in this? Now write evaluation of loan option. Evaluation of loan option. Evaluation of loan option. Let us assume the interest rate to be x. Let us assume the interest rate to be x. Interest rate to be x. Full stop. Hence interest rate for first year, interest for first year will be 5 lakh x, comma, second year would be 4 lakh x and so on. Second year would be 4 lakh x and so on. Create the table and get me the answer. The analysis indicate that the interest rate should drop to 9.05%. In fact, if you've got this 9.05%, I'll tell you whether this equation becomes right or not. Any doubts on 9.05%? Okay. The earlier total was 343,812. If you see earlier when we did original loan evaluation, in this if you substitute, you will get x is 10%. If you substitute in this equation, you will get x is equal to 10%. So we are basically, whatever was the rate, we had, instead of writing the rate, we have put a x and got a structure. The structure says my final outflow is going to be 255,675 plus 881,370, x is equal to 335,412. In that process, x is equal to 9.05%. Original 343,812, if you check, x is equal to 10%. So in case he wants to reduce the lease rent, I would want the rate of interest to drop to 9.05%. Rate of interest should drop to 9.05%. Any doubts on this? Clear? Can you proceed? Okay, now listen. Residual value which will make the firm indifferent with lease rental of 1,20,000. I'm not going to evaluate the lease part. Lease part is already done. When you do the loan part, all this is going to remain same. The salvage value portion is x. The salvage value portion alone is x, because they are saying residual value which will make the firm indifferent to the loan option. So salvage value is going to be x, and then based on that we do the problem. We'll quickly do in a short way. Now write part 3, computation of indifferent residual value. Computation of indifferent residual value. Computation of indifferent residual value. Point number 1, present value of lease option. Present value of lease option. Present value of lease option would continue to be 335,412. Present value of lease option would continue to be 335,412. Would continue to be 335,412. Any doubts on this? Next point. Let us assume the residual value to be x. Let us assume the residual value to be x. Let us assume the residual value to be x. Residual value to be x. Full stop. PV of loan option is analyzed below. 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 Year cash flow PV of DCF. Year cash flow PVF DCF. I want to do all the calculation again. 1, 2, 3, 4 same number, whatever was there earlier. Year cash flow PVF DCF. 1, 2, 3, 4 is same number. 105, 98,000, 91,000, 84,000. When I change the residual value, first 4 years no impact. First 4 years is no impact. 105, 98, 91, 84, no impact at all for the first 4 years. Can you tell me what will be the cash flow for the 5th year if salvage value is X? 70, that is 10 lakh plus 1 lakh minus 33,000, 77, what you said, 77? No. So what? Yeah, listen, what is happening on the salvage values? When the salvage value was 50,000, we wrote only 35 because 30% went in taxation. 30% went in taxation. So we have assumed salvage value to be X. Net salvage value is 0.7x. Salvage value is X because in this case there is no book value. If there was a book value, then I would have done sale value X, book value so much, capital gain so much, tax so much, and NSV I would have done and then come back. But good part is there is no book value left over. So last year is 10,000 of interest, 1 lakh of principal, 33,000 of depreciation benefit, and salvage value of 0.7x, and this should equate to 33. What was the number? Lease option is 335,412. It should equate to 335. Listen, one more thing. The first 4 years amount could have also changed if the question had said depreciation without that line, because if my salvage value is changing, depreciation will change for all the 4 years. If that line was missing saying that full depreciation, you would have changed the depreciation for all the 4 years. Be very clear on the concepts. Let's not worry about the computation angle of it. Focus more on having clarity on the concept. In case depreciation, that line was missing, I would have changed the depreciation for every year. See, the point is, this is the structure. Now, in this structure, what will undergo a change is something which you should be very clear. Interest is not going to change, principal is not going to change, depreciation is not going to change, tax saving on interest and depreciation is not going to change, salvage value is going to change. When interest was changing, interest will change, principal remains same, depreciation remains same, tax saving on interest and depreciation change, salvage value remains same, NCF change. There were multiple changes, so I had to do the detailed calculation. Here only one item is changing, so we are directly writing it. You equate and tell me the salvage value finally. 1,05,000, 98, 91, 84. This number, PVF, DCF. If residual value slightly moves up, then also I'm fine to make it indifferent. If 1,20,000 is the LR they want to charge, at least my residual value should be 67,000 so that I get a loan and buy the asset. If I have to buy the asset through a loan route, I need at least 67,621 of residual value. 67,621 of residual value. Let me know whether you are getting this. If you are getting different, please let me know about it. What happened? Just check. If at all there's a mistake, your PVFs would be whatever you had earlier written, 926, 857, 794, 735 and 681. Let me know if there's a doubt here. Getting, not getting? Okay, discount rate. 67,621 is the lease rent. Sorry, residual value. Any doubts on this? Can we proceed? Take your time. Let me know if there's a doubt. One 105 and 98. Can we proceed? Any doubts on this? Okay, now listen. Last part says initial cost payable which will make the firm indifferent to the loan option with lease rent of 1 lakh. Now this is a very tricky part. Listen, what is the loan amount? What is the cost of the asset today? 5 lakhs. When the cost of the asset is 5 lakh, loan is 5 lakh. Now my cost of asset is X rupees. My cost of asset is X rupees. They said initial cost payable which will make the firm indifferent. Now this will be X rupees. Interest will be 10% of X. Repayment will be 0.2x. Repayment will be 0.2x, 1 by 5. And closing balance is 0.8x. Closing balance is 0.8x. Interest will be 10% of 0.8. So I'll directly do this. If you see, first year interest will be 10% of X. Second year 10% of 0.8x. Third year 10% of 0.6. Fourth year 10% of 0.4. And fifth year is 10% of 0.2. Principal is going to be 0.2x in all the 5 years. Depreciation is going to be 0.2x in all the 5 years, because depreciation will depend on the cost of the asset. Tax saving on interest and depreciation you will calculate. Salvage value will continue to be 35,000. NCF you will get, PVF, DCF will be equated to 343,812. Again, next, right? Part 4. Calculation of indifferent cost of the asset. Computation of indifferent cost of the asset. Computation of indifferent cost of the asset. Indifferent cost of the asset. Point number 1, the present value of outflow of lease option. Present value of outflow of lease option would continue to be 335,412. Would continue to be 335,412. Would continue to be 335,412. Let us assume the cost of the asset. Let us assume the cost of the asset to be X. Let us assume the cost of the asset to be X. Let us assume the cost of the asset to be X. Full stop. The present value of loan option. The present value of loan option. Present value of loan option is calculated below. Present value of loan option is calculated below. Year, interest, principal, depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF, DCF. Year, interest, principal, depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF and DCF. Okay, first year interest is 10% of X. First year interest is 10% of X. And parallelly I write repayment of the first year is 0.2x. First year interest is 10% of X, principal is 0.2x. Second year interest is 10% of 0.8x. 10% of 0.8x. And principal will be 0.2x. 10% of 0.8x, you repay 0.2x, so balance is 0.8x. Third year is 0.0x and principal is 0.2x. 0.06x and principal is 0.2x. 0.4x and principal is 0.2x. And last year is 0.02x and principal is 0.2x. Depreciation is how much? It's 0.2x, it's not 1 lakh. It will be 0.2x because the cost is changed. So that's why be very clear on what you are changing. If you work on concepts, things will be easy. Depreciation is 0.2x for all the 5 years. Tax saving on interest and depreciation is 0.3x. What is the tax rate? Okay, 30%, 0.09x, 0.084x, 78x, 72x, 66x. Interest and depreciation, 30% of interest plus depreciation. 30% of interest plus depreciation. 30% of interest plus depreciation. Any doubts on this? Will the salvage value change? No, because listen, the salvage value is not changing because asset is fully depreciated. In case it was not to be fully depreciated, then you would have written book value as X minus some number and done the calculation. So salvage value continues to be 35,000. Original amount 35,000. Interest plus principal minus tax saving on interest plus depreciation. For a rental of 1,20,000, the cost should be only 4,88,506. The cost should be 488,506. Like this, I can do indifferent analysis on multiple parameters. The parameters which can impact my decision is lease rentals, residual value, original cost, interest, yeah, the residual value. So these are the 4 parameters we have seen. Broadly, these parameters should take care. Apart from this, we can bring in a lot of changes, saying that the lease rental is not going to be same, it is going to vary every year, or you may bring equated annual installments as the repayment mode, or the only principal as the repayment mode. So multiple repayment modes are available. Net, if the lease rent, if the cost of the asset is 488,506, in fact, whatever you have created, no, 0.7354 into 5 lakh, that X was the 5 lakh, into 5 lakh, minus 23,835 if you do, you should get that original amount. Otherwise, there is a mistake. 343,865. Some rounding of differences can be there. The earlier amount was 343,812. Now, if I substitute 5 lakh, I get 343,865. If I substitute, so we have created a structure in such a way that in that place, if you substitute X, what are you going to get? Clear? Any doubts in this? Any doubts in this part? Done? Can you proceed? So this is exhaustive analysis on leasing. In fact, from a lessee point of view, we have done that. It continues to be lessee evaluation. Okay, now I'll come to something called as a discount rate. A very critical item. Discount rate, let's assume cost of capital is given. Cost of capital is given in the question. Discount rate equal to COC, cost of capital. COC not given. Discount rate is equal to post or cost of debt into 1 minus tax rate. Technically called as after tax cost of debt. Technically called as after tax cost of debt. In fact, all authors here, this is what you should follow. This is what you should follow. You should not even worry about cost of capital. Why we should follow after tax cost of debt is we are comparing leasing versus loan. Leasing versus loan is what I am comparing. Loan comes at an interest rate. That is basically the risk of that. So when a lender is giving me a loan at some rate, he believes so much risk is there. The concept says that any cash flow has to be discounted at after tax cost of capital. When you take a loan, the after tax of capital, the WACC will be equal to cost of debt, because you are only taking a loan, you are not putting your own money. So logically speaking, both the set of cash flow should get discounted only at something called as cost of debt, after tax cost of debt. Institute doesn't do this consistently. Some questions, they have clearly mentioned that cost of capital is given, but they'll give a note saying that the discounting has been done as after tax cost of debt, even when the COC is given. In exam, if COC is given, you do discounting at COC, that will work at 90% of the question, and write a note that the discounting is done at the cost of capital as given in the question. Alternatively, the discounting can be done at after tax cost of debt, so that you give a view to the examiner saying that I'm aware of this concept. I could have done it that way, but I'm doing it this approach. I'm doing this approach. 90% of the answer institute will do at COC. 90% of the answer institute will do at COC. Some solution will be at after tax cost of debt. And if the problem is silent, that's great. That's the best thing. If the problem is silent, I go ahead and do at after tax cost of debt. I'll not worry about all of this. I'll not worry about all of this. I'll do at after tax cost of debt. Any doubts till now? Okay. Now, when I do at after tax cost of debt, I'm going to explain you a shortcut now. We did all of this, no? We did all this in the earlier question. Let's assume the discount rate is 7%. Let's assume it is 7%. 7% would have been equal to after tax cost of debt. 7% would have been equal to after tax cost of debt. Any doubts in this? Earlier question, I'm just taking the numbers and I do at 7%. If I do at 7%, the answer is 352,023. 35, just a moment. Okay, the answer comes out to be 352,023 if you do at 7%. In case my discount rate and after tax cost, in my discount rate and after tax cost of debt is same, you need not do all of this. There's a shortcut to the answer. There's a shortcut to the answer. Institute doesn't adopt it, but that's the shortcut. Many authors have talked about this. Now listen, in case my discount rate and after tax cost of debt is same, I'll do something called as cost of asset. What is the cost of asset in this case? 10 lakhs. 10 lakh less present value of depreciation benefit. What is present value of depreciation benefit is 30,000 every year. 30,000 every year. 1 lakh was the depreciation, 30,000 is the benefit. 5-year benefit you get. Sorry, what was the cost of the asset? 5 lakh, sorry. 5 lakh. Present value of depreciation benefit is 30,000 into 5-year annuity factor less present value of salvage value. Present value of salvage value is 35,000 into 0.713, and if you put a total of this, it will match to that 352023, 352045. That is a rounding off difference of 22 rupees. Otherwise, both will match. The logic is when interest rate and the discount rate is same after tax. When the interest rate and after tax discount rate is same, there's no point in calculating interest and principal. There's no point in calculating interest and principal. For example, we had this, no, I'm removing this depreciation for the time being. I'm removing the salvage value. Okay, I'm paying interest at the rate of 10%. I'm discounting. If you see, the total will be 5 lakh. The total here is 5 lakh. When the discount rate and interest rate is same, interest and principal can be substituted by the amount of asset. Interest and principal can be substituted by the amount of loan. So if you see here, cost of asset is nothing but interest plus principal. Depreciation is taken care of. Salvage value is taken. These are the only 4 items you take: interest, principal, depreciation, tax benefit on depreciation, tax benefit on interest, and salvage value. Whenever my interest rate and the discount rate after tax, both have to be after tax, if they are same, there's no point in calculating interest and principal. There's no point in calculating interest and principal, because mathematically what will happen is, in case both are same, in fact here I have done some discounting, I have rounded off. If I do a rounding off, let's assume, you will see exact 5 lakhs. You will end up seeing exact 5 lakhs. Whenever the discount rate and after tax cost of debt is same, whenever the discount rate and after tax cost of debt is same, there's no point in calculating. In fact, your loan evaluation will get over here itself. Only 3 line items: cost of asset less present value of depreciation benefit less present value of salvage value. What is cost of asset is nothing but interest, principal, and tax saving on interest. All 3 things put together: interest, principal, and tax saving on interest. Depreciation benefit is tax benefit on depreciation. Salvage value is written. Any doubts on this? So this is what we will do in case the interest rate and after tax cost of debt is same. It's covered in the theory part. If both are same, we are going to use the shortcut. The logic is, whenever the discount rate and the rate of interest is same, in the process of discounting you will go back to the original value. In the process of discounting you will go back to the original cost of the asset. Clear? Any doubts in this? Okay. Earlier question I didn't want to introduce all of this. Anyway, the discount rate was different. Now onwards we will see whether the discount rate is same as after tax cost of debt. If it is same, only 4 line items: cost of the asset less present value of salvage value less present value of depreciation benefit and PV of outflow of loan option. Lease option, year cash flow, PV of DCF, and we are done with it. In case it is different, then you need all of this: interest, principal, depreciation, tax saving on interest and depreciation, salvage value, NCF, PVF, and DCF. Any doubts on this? One more thing, some question will say taxes are paid 1 year in arrears, 1 year in advance. In all those scenario, the shortcut will not work. The shortcut will work only if one, interest rate is equal to after tax cost of debt and you pay taxes every year. Some question will say taxes will be paid 1 year in arrears, 1 year in advance. In all those scenarios, this is not going to work in. Clear? Any doubts on this? Done? Let's start now. Let's do question number 2. Messrs. Gamma and Co. is planning of installing a power saving machine and are considering buying or leasing alternative. Machine is subjected to straight line method of depreciation. Gamma and Co. can raise debt at 14% payable in 5 equal annual installments at the beginning of the year. In case of leasing, company would be required to pay an annual end of year rent of 25%. 40% tax bracket, salvage value is estimated at 24,998. Evaluate the two alternatives and advise the company by considering after tax cost of debt. Calculate the, okay, part 2 and part 1 has no linkage. I have added it from some other question. Go through the questions. Go through the question. Okay. Now in this question, the interest rate is 14%. What should be the discount rate for this question? What discount rate should we use? How much? 8.4%. So the discount rate is going to be same as after tax cost of debt. We are going to use the shortcut to get the answer. Even if you do in the long approach, you are going to get the same answer. Do we know the cost of the asset? Okay. In all the problems, cost of asset will be equal to the loan. Cost of the asset will be equal to the loan, and I can calculate the loan amount because I know how the repayment is going to happen. I can calculate the loan amount because how the repayment is happening is given in the question. Now, working note 1, computation of cost of asset. Computation of cost of asset. Computation of cost of asset computation of cost of asset. Now listen, there's a formula called as annual installment is equal to loan amount okay, listen, normally it's divided by annuity factor r comma n. It's normally called as annuity factor r comma n. That is, if you pay it at the end of the year, you're going to divide it by the annuity factor. How the repayments are happening? At the beginning of the year. It's technically what you need to do is, see, when you do repayment at the end of the year, you're going to add the factor for 1, 2, 3, 4 and 5 year. If you do it at the beginning of the year, you need to add it for 0, 1, 2, 3, 4. So it's a 4-year annuity factor plus 1 to it. If you are paying at the end of the year, it's a 5-year annuity factor. If you are paying at the beginning of the year, it's a 4-year annuity factor plus 1. Why plus 1? Because for year 0, it's going to be 1. What is the discount rate? What is the interest rate? Interest rate. See, when you do annuity, when you do the calculation of installment, it's going to be 14%. So listen, 1 plus PVAF 14% comma 4 years. 14% comma 4 years. Otherwise, it would have become PVAF 14% comma 5 years. It would have become 5 years. Now we will do only for 4 years. installment was 178,858. Loan amount divided by 3.9138. It's around 7 lakh rupees. 7 lakh rupees the cost of the asset. Any doubts on this? 7 lakhs is the cost of the asset. Can you proceed? Okay, now this is not required, it's for a better understanding. Because anyway I am going to use a shortcut method. So listen, if I am going to repay at the beginning, it will start with year 0 itself, okay. I am going to repay at the beginning. We take a loan of 7 lakh, no interest in year 0. Year 0 is basically a single day, and immediately you pay 178,858. Immediately you pay 178,858. My closing balance is opening plus interest minus principal. Next year, this is the opening balance. You charge an interest at the rate of 14%. Tax benefit is something which I get later on. Interest will be charged at 14% only. Principal, this is not principal, sorry. Installment. And my closing balance is opening plus interest minus installment. So this will become 415. Then 415 is the opening balance, 58,134 is interest. You repay this, you get a closing balance of so. Opening balance, repayment you get, and last year this is technically 0. Your loan is closed at this year. At the beginning of 5th year, you close the loan. So last year there is no interest, no principal, and no closing. The closing balance is anyway 0. In the beginning of 5th year, we close the loan. Beginning of 5th year, I close the loan. Any doubts on this? Any doubts on? So we started with 7 lakh. 178,858 is the installment. Closing balance became 5211 on that interest installment. Now you may have to do this table if the discount rate was something other than 8.4. If the discount rate was anything other than 8.4, then I need this. Year, interest, principal, depreciation, tax saving on depreciation. You need all of this in your notebook in case you see a difference. Any doubts on this? So loan amortization table is something which is mandatory in case you have to calculate interest and principal or interest and installment. Any doubts on this? Clear? Okay. Next, working note 2. Present value of outflow of loan option. Present value of outflow of loan option. Present value of outflow of loan option. Particulars calculation amount. Present value of outflow of loan option. Particulars calculation amount of outflow of loan option. Particulars calculation amount. Particulars calculation amount. The first thing is cost of asset. This is my outflow. Cost of asset. Cost of asset 7 lakh rupees. Cost of asset 7 lakh rupee. It's in fact in institute answer, if because of rounding off we get a different answer, otherwise it should have been 6,99,998. That's what the number would be, but we will work with 7 lakh number. Any doubts on cost of asset? Point number 2, less present value of depreciation benefit. Present value of depreciation benefit. Listen, in case it's WDV, do a separate working note and you'll have to calculate depreciation every year. Good part is it's SLM. Can you tell me what will be depreciation every year? Depreciation every year. Per annum depreciation. So what is the amount? How much? Okay, 1,35,000. Listen, 1,35,000 into 40%. That's the tax benefit into 40% into PVAF 8.4%, 5 years. The discount rate is 8.4% for 5 years. Into 40% is to write the tax benefit. Depreciation is of no use. Only the tax benefit is of use. So 1,35,000 into 40% into PVAF 8.4%, 5 years. Do this and let me know the number. 1,35,000 into 0.4 into PVAF 8.5%, 5 years. The annuity factor is 3.951. $213,354. 213,354. 213,354. Any doubts on this? Less present value of net salvage value. Present value of net salvage value. In this case, sale value and net salvage value will be same. 24,998 into PVF 8.4%, 5 years. PVF is the normal factor, PVF is annuity, 0.668. Correct. Correct. So in that case, NSV and sale value is same. Your salvage value, sale value minus capital gain. So both are same. In a hurry, sometimes people take it as capital gain minus. It's not that. It is sale value minus tax. All those questions, the book value was 0, so it was working out that way. Present value of net salvage value 16,699. $16,699. PV of outflow of loan option. The same thing we may have to do a detailed calculation in case both had not remained same. If my discount rate and after tax cost of debt is not same, I have to do that loan amortization table and then prepare that 8 columnar table to get to the answer. Present value of outflow of loan option 469,947. 469 947. Any doubts on this? If you look at institute solution, they would have done the same thing through a loan amortization table. Answer would match. Your answer is going to match. 469 947. Some up down rounding off can happen, but broadly the solution is going to be this. Any doubts in this? Working note 3. Present value of outflow of lease option. Present value of outflow of lease option. Do one, let you do this. Present value of outflow of lease option. What's the lease rent every year? How much? 1 lakh? No. $1,75,000. I hope you have done this into 0.6. If you have done that, that's great. It's 1,75,000 into 0.6. Tax rate is 40%. 175 is right, but you will have to do into 0.6. Into 0.6. $3.951. Tax will play a big part in the solution. 414,855. If I don't consider tax, it could give me altogether a different solution. 414,855. 1,05,000. 3.951. 414,855. 414,855. 1,05,000. 3.951. 414,855. 414,855. 414,855. 414,855. Any doubts on this? Clear? Okay, the second part and first part has no linkage at all. Calculate the annual percentage rate implied by the bank's offer with interest payable every 6 months. Also calculate the amount of installment payable at the beginning of each 6-month period if the offered loan is to be repaid in equal installments. Okay. Now, lot of times if you go to a bank, they'll say rate of interest is 10% per annum, but that's not 10% if you are going to repay every month. If I'm going to repay every month, it's basically 10 divided by 12, 0.833% per month. and per year rate is 1 plus 0.833 power 12 minus 1. If I am repaying every month, I have to do monthly compounding. In this case, they are saying calculate the annual percentage implied by the bank's offer with interest payable every 6 months. If interest is payable every 6 months, it's 14% for a year, 7% for 6 months, and when you pay 7% every 6 months, it will not again go back to 14. It will not go back to 14. Annual percentage rate equal to 1 plus r the whole power n. Annual percentage rate is equal to 1 plus r the whole power n minus 1. Annual percentage rate is equal to 1 plus r the whole power n, 1 plus r the whole power n minus 1. Lot of times the banks will indicate to us saying that this is the loan we are offering, but it's not 14% per annum effectively. 1 plus r the whole power n minus 1, APR is equal to r is 7% power 2 minus 1. If I have to repay every 6 months, the rate of interest is not 14%, it's 14.49%. 1 plus r the whole power n minus 1. 14% is for a year, 7% is for 6 months. In practical world, you will see whenever you are going for a loan, the bank will say the rate of interest is 10% per annum. When you go for an FD, if you go for FD, they will say 7% compounded quarterly, and they will say effective rate is 7.8. They themselves will indicate the effective rate to us because they want to sell the product of deposit to be made. When it is loan, they will not tell you the effective rate because effective rate is always higher than the normal rate if the compounding frequency is less than a year. And what is compounding frequencies? When do you pay? Most of the times repayment of a loan is monthly, but interest on FD never comes monthly. Interest on FD will not come monthly. Most of the times it's either yearly or quarterly. It's yearly or quarterly. Whenever it is quarterly, they will talk about an effective rate of interest. They will talk about an effective rate of interest. If you look at, you go to a bank and see FD, and whenever they give FD interest rates, they will talk about an effective rate of interest, saying that you will earn more. It's 8% compounded quarterly, so you earn 8.5%. But when you repay a loan, they will not mention about the effective rate. That is something which we have to take into consideration. Any doubts in this? Which one? If you take a
and installation period is EMI period is 6 months, down payment 20,000 So next 6 months you will be paying only 10,000.
Effectively, you should go ahead with that because their benefit is one, they make the sale, so they push you to buy the product. That's from their point of view. There is an interest in this. Interest is not paid by you. So if let's assume Amazon is selling it, Amazon will pay the interest to the bank. Why is Amazon or the seller is doing it? So that you buy the mobile phone. So they want you to buy it. They have their profit in. So if it's for example, a mobile phone is available at 40,000 with a no cost EMI and normal payment, I should ideally opt for a no cost EMI because when I make the immediate payment, I lose that benefit. Why will I make the immediate payment? I don't want this headache of EMI to be paid, so I will end up going for a normal payment. So that is, from my point of view, I may go ahead with that. Second time, most of the times, if I'm not sure whether in a no cost EMI, maybe you will have to make the payment through a credit card. It can come in through a credit card payment. When it's through a credit card payment, there is a 2% processing charges which the bank make. From your point of view, you don't lose anything. You are not losing anything. The bank will recover this 2% from the seller. So why does a seller do? Simple. Why do I give credit to my customer? I give credit so that they buy product from me. So it's basically providing free credit. So your choice whether you want to go for a free credit or make it immediately. In a normal world, when I pay immediately, ideally they should give me a discount, which they may not offer, because if they offer, then people will distinguish between both the products and they may not opt for a no cost EMI. The reason of giving a no cost EMIs is just to push people to buy the product. and when you buy the product, their profit will be 5,000. In that, they will deduct interest of 500. 4,500 is the final profit they make. From a customer point of view, it's beneficial. It's only purely beneficial. There's nothing, unless some products will have hidden charges. They will mention that. They will mention that if I'm going to pay only 10,000 into 6 plus 20,000, then it's only benefit for us. Okay. Now they're saying, what should be the installment if the repayment happens at the beginning of each 6-month period? How many years is the loan? 5 years is the loan, 10 periods. Now listen, installment is equal to loan equal to 1 plus PVAF 7% comma 9 periods. 7% comma 9 periods. Basically, I am paying at the beginning of the year, beginning of the 6-month period. So I immediately pay for the first installment and then 9 installments of annuity. 9 installments of annuity. Earlier what we did was 1 plus PVAF 14% comma 4 years. Now it is 1 plus PVAF 7% comma 9 half years. 9 half years. The first installment comes here. Balance installment is an annuity. In fact, the formula is 1 plus PVAF in bracket R comma n minus 1. R comma n minus 1. So earlier n was 5, n minus 1 is 4. Now n is 10, n minus 1 is 9. N is 10 and n minus 1 is 9. $5 lakh. Which one? No, so the point is the form. So 1 is for the first 6 months. It's basically, if you do in the Excel, what I would have done is 0, 1, 2, 3, 4, 5, 6, 7, 8 and 9, because this only will add up to 10 installments. This only will add up to 10 installments. Earlier it was, see, the formula is 1 plus PVAF R comma n minus 1. When you did 14%, n was 5 years. Now you are doing 7%, n is 10 half years. When it's 10 half years, the first installment is basically for 1 half year. The first installment is basically for 1 half year. So if I have to do, I would have done it like this. 1.07 power. My discounting will happen like this. My discounting is going to happen like this. So instead of doing it together, when you have to do discounting like this, you will have to take the 9th period. You will have to take into consideration the 9th period. It's not 4 years is equal to 8 half years. That's not. If that is the logic, then I should not write 1. I should write 2, because 1 plus PVAF R comma n minus 1. You should do 2 plus PVAF. That's not the concept. The concept is, if you are doing every half year, the formula is not n and 2n, it is n minus 1. It's n minus 1. So earlier n was 5, we wrote 4. Now n is 10, we are writing 9. 5 lakh divided by 7.515. 66,000. Which one? 5 lakhs, no? Original loan. Whatever be the amount, I am not really bothered about it. I think we worked with a 5 lakh loan, no? Sorry, 7 lakhs, sorry. Okay, 7 lakhs, sorry. The important part is the concept rather than that amount. So if you are clear on this, whenever you are repaying something at the end of the year, the formula is divided by annuity factor R comma n. If you are paying at the beginning of the year, 1 plus annuity factor R comma n minus 1. R comma n minus 1. Any doubts on this? Clear? Any doubts on this part? Let's do question 1. P Limited has decided to, any doubts on question 2? P Limited has decided to acquire a machine costing 50 lakhs through leasing. Quotations from 2 leasing companies have been obtained, which are summarized below. Quote A, quote B, lease term, initial lease rent, annual lease rent. P Limited evaluates investment proposal at 10% cost of capital, effective tax rate is 30%. Terminal payment is negligible. Make calculation and show which is beneficial to P Limited. Okay. Now this is lease A versus lease B. Earlier we did lease versus loan. Now we have to evaluate lease A versus lease B. Like a normal problem, outflows are going to be positive, inflows are going to be negative. Working note 1, evaluation of quote A. Working note 1, evaluation of quote A. I'll come to it. Working note 1, evaluation of quote A. Evaluation of quote A. There's no big adjustment in this except for one concept. Here, cash flow PVF at 10%, DCF. The first one is 3-year lease, 0, 1, 2, 3, 0, 1, 2, 3. Now read the question carefully and tell me year 0 and year 1 cash flow. If you tell this correctly, you have understood. Year 0 what number, year 1 what number? Year 0, okay. Year 1, I don't want the final number. How are you going to calculate? You tell me that. Year 0, 5 lakhs. Year 1,
16 minus 0, 6.06.
no. Year 0, 5 lakhs is right. Year 1, what number you want to write?
Like annual rent is 21.06.
Okay.
Out of that I have already made 5 lakhs.
Okay.
So remaining amount I am paying into 70%.
No.
I am paying into tax.
16.06 into 70%. No.
Sorry. 21.06 into 70% minus 5 lakh.
No. No. Your assumption is wrong. The 21 doesn't include that 5.
Okay.
So it's an extra payment.
So it will be both 21.0706 into 70%.
Okay.
Minus 5 lakh into minus 5 lakh into 0.07 whatever.
No, you went in the right direction, but you missed it somewhere. Okay, listen. Year 1 will be 21.06. 21.06 minus 30% of 26.06 minus 30% of 26.06. That is the tax benefit on both the amounts, 5 lakh and 21.06 lakh. So at the end of year 1, you will pay 21.06 lakhs. That's your outflow. Tax benefit is 30% of 26.06. 30% of 26.06. Yeah. You said everything right, but the 21.06 into 70% and all was fine. Minus, you should have said 5 lakh into 30%. You said 5 lakh into 70% in the minus part. So the net calculation is nothing but first year is year 0 is 5 lakh. So let's write year 0 is 5 lakh. Year 0 is 5 lakh. Year 0 is 5 lakh. Year 1 is 21.06 minus 30% of 26.06 minus 30% of 26.06. 21.06 minus 30% of 26.06. 30% of 26.06. No, so year 0 is April 1. So April 1, when do you get the tax benefit? April 1, 2019. Next year. Lot of authors say that instead of taking year 0 as 5 lakh, year 0 is the beginning of the year, that doesn't mean it goes to the previous year. Lot of authors say that when you pay 5 lakh, consider tax benefit immediately, because in India we have a system of advance tax. So nobody pays tax at the end of the year. The taxes are paid throughout the year. The taxes are paid throughout the year. So lot of authors say that let's not take tax benefit at the end of the year. Take the tax benefit whenever an expense happens. If an income happens, so in my case, if I'm getting a salary, immediately TDS is deducted. So the basic rule is, if income is happening in year 0, tax also will happen in year 0. If expense is happening in year 0, tax should also happen in year 0, but most of the problems, are at least 100% of the problem, institute follows this only. Tax benefit at the end of the year. Year 2 and 3 is very simple, 70% of 21.06. In fact, it is 70% of 5, 70% of 21.06, 70% of that, 70% of 5 is not possible, so we wrote 5 and we wrote the balance 30% below. 70% of 5 is not possible to be written, so we wrote 5 fully and removed the 30%. And PVF for 10%, follow whatever is given in the question. If the question gives you 2 decimal PVF, follow them. Else, if we are doing, it's normally 3 digit. 1.91, 0.83. When you do the multiplication, they want a 2 decimal answer. Rounding off to be done in 2 decimals in lakhs. Which one? First year?
I kept a formula 21 lakh 6,000 into 70% minus 5 lakh into 30%.
Correct.
I'm getting 14.
Then do into 0.91. Do into 0.91. DCF you do into 0.91. No, you will get 12.05.
I'm just talking about cash flow itself.
So that should be right. Whatever you are getting should be right. Are you getting the same answer? The formula is right, 70% of 21.06 minus 30% of 5. Now we'll have to do a similar calculation for the second quote. The critical adjustment is already explained, so similar calculation for quote B. You will do a similar calculation for quote B. Whatever is the critical adjustment is already explained. We'll do the similar analysis for quote B. Quote A had 40.35 lakhs of outflow. Quote B has 44.35 lakhs of outflow. The adjustment was only that one critical adjustment, which is in case you paid at the beginning of the year. We have already seen this in some other question where we had assumed X and done the calculation. So, quote A 40.35 lakhs, quote B 44.35 lakhs, 40.35 and 44.35. 40.35, 44.35, 40.35 and 44.35. Any doubts on 44.35? So in quote A I spent 40 lakh rupees, quote B I spent 44 lakh rupees. Which is better? Which is better? You cannot decide with this because quote A has a life of 3 years, quote B has a life of 4 years. Next working note, computation of equated annual cost. Computation of equated annual cost. Computation of equated annual cost. Computation of equated annual cost, particulars, quote A, quote B. Computation of equated annual cost, particulars, quote A and quote B. Computation of equated annual cost, particulars, quote A and quote B. What is the formula for EAC? Present value of outflow divided by PVAF, divided by PVF. Point number 1, PV of outflow. PV of outflow 40.35 and 44.35. Life is 3 years and 4 years. Life is 3 years and 4 years. You add the factors given in the question, don't do in the calculator. 1 divided by 1.10 will not work. They have given 2 digits number. So 3 year is summation of 3 factors. 4 year is summation of 4 factors. The factors are given in the question. 3 year is summation of year 1, 2 and 3 factor, and 4 years is summation of 1, 2, 3, 4 factors. So it depends. What EAC says is, if it's repetitive, when I say repetitive, if you want for 4 years, go with quote A for 3 years and tell him that I'll also get you again for 1 more year. If that is possible. See, EAC concept is it should be repetitive. That is 3 years and 4 years. So if it's 3 years, doing 3 years 4 times will give you a life of 12 years, and doing 4 years 3 times will give you a life of 12 years. So EAC works only if you are going to repeat it. If you cannot repeat it and says that I'll give you for 3 years, don't come back, and he says for 4 years, I'll have to go ahead with 4 years. I don't have an option now. I don't have an option. I will have to go with 4 years and complete it. So EAC concept is something which can be repeated. You can write a conclusion. The company should go ahead with quote B. Company should go ahead with quote B as it has lower equated annual cost. Company should go ahead with quote B as it has lower equated annual cost. Quote B as it has lower equated annual cost. Clear? Any doubts in this? Let's move to question 3. We'll do 3 and then take a break. Go through 3. Go through question 3. Okay. Bright Limited is considering acquiring an additional computer to augment its timeshare computer services to its clients. 2 options: purchase for 44 lakhs, take the computer on lease for 3 years from a leasing company at an ALR of 10 lakhs plus 10%. Agreement also requires an additional payment. Company estimates that the computer will be worth revenue. All this is given. You are required to evaluate whether to lease or buy the asset. Is any discount rate given in the question? Have they mentioned anywhere cost of capital, any discount rate? So what will be the discount rate? After tax cost of debt. What should I do with these items? Gross revenue, operating cost. What is to be done with these items? So that is okay. Lease rent is fine. When I evaluate the loan option, let's assume I'm evaluating the loan option. What should I do with these? Why should I ignore?
Because I'm only evaluating my.
Yeah, so revenues total ignored, annual operating costs total ignored, because these costs or revenues will be earned irrespective of whether you are buying the asset or leasing the asset. The decision is to decide on whether to buy or lease the asset. The decision is not whether the computer is required or not. Whether the computer is required or not would be step 1, initial outflow 44 lakhs, step 2, in between flows. In between flows all this will come. In between flows, all this will come. Terminal flow, consolidate, calculate NPV. If NPV is positive, get the asset. If NPV is negative, don't get the asset. The moment you have decided you want the asset, it means you have already done all this analysis. After deciding you have to get the asset, now you are deciding whether to buy the asset or whether to take it on lease. So in that analysis, revenues and all will not come. In fact, this item itself would have been totally of no use. Only one place I am going to use it, because they said rental is 10% of the gross time share service revenue. For that purpose alone it will come. Revenues same in lease and loan. Annual operating costs same in lease and loan. Startup and trading some 2 lakhs same in lease and loan. What matters is interest is going to be varied, depreciation is going to vary, lease rentals is going to vary, and also in this case the discount rate and after tax cost of debt is same. So when I do my loan option, only 3 line items working. Point number 1, cost of the asset. Point number 2, less present value of depreciation benefit, less present value of salvage value, get the overall number, decide whether. That's the loan option answer. Lease, year, cash flow, PVF, DCF. Clear? Any doubts? Now write point number 1, gross revenue. Yeah. So you will have to write an assumption then whether these costs are to be borne in both the scenario or in only loan scenario.
Because you need to it after the usage and bring it back to the
Correct. So that's what. So you can take an assumption. In case you are taking an in case you take an option stating that it is not going to be incurred, in case you make an assumption saying that this will not be incurred, then listen, I will get into this format: interest, principal, depreciation, one more item called as annual operating cost, tax saving on interest, depreciation and annual operating cost, salvage value, NCF, PVF and DCF. I will get into that format. If you believe AOC is only incurred, see, if it's incurred for both, then ignore. If it's incurred for only one, then you will have to obviously consider. Now write point number 1, revenues and annual operating cost. Revenues and annual operating cost. Revenues and annual operating cost are common. Revenues and annual operating costs are common for leasing and loan proposal, are common for leasing and loan proposal, are common for leasing and loan proposal, full stop. Therefore this would be ignored. Therefore this would be ignored in cash flow computation. This would be ignored in cash flow computation. This would be ignored in cash flow computation. Ignored in cash flow computation. Clear? Okay, next. Evaluation. Okay, next point. The discount rate and the after tax cost of debt is same. The discount rate and the after tax cost of debt is same. After tax cost of debt is same. Full stop. The present value of outflow of loan option. The present value of outflow of loan option. The present value of outflow of loan option can be computed using the shortcut method. 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 Let's start. Particulars calculation amount. Particulars calculation amount. Particulars calculation amount. Cost of the asset less present value of depreciation benefit less present value of salvage value PV of outflow of loan option. Cost of the asset less present value of depreciation benefit less present value of salvage value cost of the asset less present value of depreciation benefit present value of salvage value PV of outflow of loan option. What's the cost of the asset? 44 lakhs. 44 lakhs. Can you tell me what will be the per annum depreciation? 44 lakhs minus salvage value is how much? 20 lakhs. Okay, 8 lakhs into what's the tax rate? 50% into PVAF 8% comma 3 years. 8% comma 3 years. %, comma 3 years. 8 lakh into 50% into PVAF 8%, comma 3 years. 8 lakh into 50% into PVAF 8%, comma 3 years. SLM makes it easier. WDV means you will have to do a separate working note. Salvage value 20 lakhs will be the same amount. There is no tax, capital gain, capital loss into PVF 8%, comma 3 years. PVF 8%, comma 3 years. 1 divided by 1.08. The factor is 0.794 into 0.794. PV of outflow of loan option 1781,200. 1781,200. PV of outflow of loan option is 1781,200. Loan option is 1781,200. Clear? Any doubts on this? Now this is loan option. Next working note is lease option. Present value of outflow of lease option. Whenever the problem is silent, discount rate is after tax cost of debt. What's the first year lease rent? How much? 7 lakh 25 to take the computer on an annual lease of 10 lakh. Okay, 7 lakh 25,000. Year 2, 7 lakh 50. Year 3, 13 lakh. It's basically 10 lakh plus 10% of revenue into 50%. So 10 plus 4.5 into 50%, 10 plus 5 into 50%, 10 plus 5.5 plus 12 into 50%. So which is 13 lakh 75,000. 1 divided by 1.08, 3 years. The lease rent looks to be very high, so we will go ahead with the loan option. We will go ahead with the loan option. Loan option is preferred route in this case. 24 lakh 5,850 is the lease rental which we are getting. Any doubts on this? Clear? Let's take a break of 30 minutes and then I continue with leasing, the balance areas of leasing. Today leasing will surely get over. Whether we start factoring or not, we'll see.